There are two theories about investing. Active investing, when you try to beat the market with timing and stock picking. And then there's passive investing, where you're content with matching the market. CBS MoneyWatch's own Larry Swedroe is the author of a new book, The Quest for Alpha, in which he lays out volumes of evidence that the passive strategy is the one that wins. Welcome, Larry. Thanks for being here.
Good to be back, Eric.
All right, so alpha. What is alpha exactly?
Sure, it's outperformance or underperformance, if it's negative alpha, against an appropriate risk-adjusted benchmark. So if you invest in stocks and outperform bonds, we wouldn't call that alpha, right? It's because stocks are riskier than bonds. Same thing is true if you invest in small-cap stocks or value stocks or emerging market stocks. You should expect to outperform, say, large growth stocks, because large growth stocks are safer. So what you have to do is compare active managers to an appropriate risk-adjusted benchmark.
Okay, so alpha is another word for beating the market, but beating the right market.
The
right
market
benchmark,
right.
Okay, so that's what people should try to do, right?
Well, the question is, which is most likely to allow you to achieve your financial goals? We know Wall Street needs you to believe that active is the best strategy, because they need you either to trade a lot, so they make a lot of money on your trading activity, or they need you to pay them big fees for their advice to help you beat the market one way or the other.
There's a whole industry, as you said, built around the idea that active investing works. And there are people with long track records of beating the market. What makes you think that that's not likely to happen?
Well, the book, in this case, The Quest for Alpha, looks at the peer-reviewed evidence from journals published on individual investors in their quest for alpha, mutual funds, pension plans, hedge funds, and venture capital, and even this new field of behavioral finance, where academics have said there are people who make mistakes and we can exploit them, and we'll create mutual funds to do that. And in every case, it doesn't matter which of those categories we looked at, here's two things. The average fund dramatically underperforms. So people say, well, Larry, I don't care about the average fund, I'm going to only buy the winners. The problem is the evidence also shows that there's no evidence of persistent performance beyond the randomly expected. So what that means is we cannot look at past performance and then tell you that that will likely lead to future outperformance. That's why the SEC has that disclaimer.
Is there anything different you should be doing now than you should have been doing at the bottom of the market?
Absolutely not. The only thing that I would say is this to people. You need to have a plan. If you don't have a plan, you're not likely to stick to it, because your emotions are going to get in the way. You'll be chasing returns, forever buying whatever went up yesterday, like gold and silver now, and you'll forever be selling after things have gone down. It's like driving forward by looking through the rearview mirror. That's one of the big reasons most investors do poorly. The last thing I'll close with is this. Active management certainly can allow you to beat the market. It provides the hope of doing so, and that's what keeps it alive. But I like to say it's a triumph of hope and hype over wisdom and experience, because the vast majority of the people who do it fail. And what's even worse is this. The very small percentage of the active managers who win tend to outperform. Their alphas are small, about in the range of 1% a year. The ones who fail much worse. They tend to be more in the range of 2 or 3% a year. Since there are so many more losers than winners, the risk-adjusted odds in after-tax accounts is close to 30-1 over long time periods. Now, you may want to take your money to the racetrack with those kind of odds and be willing to lose some entertainment dollars, but I don't think you should take your retirement account there to the racetrack, and I don't think you should take it to the Merrill Lynch or the equivalent office either.
All right, Larry. Thanks very much. So, the quest for alpha is a fool's errand. Don't do it. Listen to Larry Swedroe and to us at CBS MoneyWatch. Thanks for watching.